Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very good day today. And in today's markets, guys, well, the index is pretty much ending red across the board, most of which were down almost 1%, inclusively of the SPY and the QQQs. However, today was not without headline volatility. What started off the morning as a big red day with some continuation to the downside was quickly reversed in the early hours of the morning as we got news out of Scott Bessent saying the trade deals could come this week after further tariff talks, saying that they were negotiating deals with 17 major trading partners yet, but no formal deals were announced. Thereafter, we did have some other news later that morning when we got a meeting person to person between Prime Minister Mark Carney of Canada and President Trump himself, where President Carney was saying that Canada was definitely not for sale. But they did also say one thing in that meeting, and it was Trump hinting at something very big, saying that there is a very, very big announcement ahead of the Middle East trip later on this week. And Mark Carney, during that session, saying that he was on the edge of his seat. It's funny because if you take a look at the video, he's actually kind of sitting on the edge of the seat. But I digress. Anyways, that was some major news today. And of course, you can see by the futures overnight right now that we're up almost 1%. Well, the news that came out roughly 15-20 minutes ago was the fact that, well, we are actually getting some formal talks between the US and China this week. Bessent and Greer to meet with Chinese officials in Switzerland later that week. And that does include Chinese Vice Premier He Lifeng, which is widely viewed as China's economic czar and chief trade negotiator. That was the news that really rocked the markets in the after hours, sending the markets to the upside. So you can clearly tell from the positive impacts of those different news catalysts throughout the day, whether it was Bessent talking about the 17 trade deals, or the talks between Mark Carney and President Trump himself, or the after hours news with China. Obviously, the market still only wants one thing and one thing only, which is trade talks and trade negotiations for possible reduction in those tariffs. Now, in terms of today's video, guys, that was the news recap. In terms of today's video, we're going to be jumping into a few things together. I have 4 company earnings to present to you guys, and those are going to be the following: Celcius Holdings, AMD, Ferrari, and Arista Networks. Shout out to so many other companies that were on this page for today, but unfortunately, I just don't have time to do it all, so I've chosen those 4 as the ones we're going to go for today. Thereafter, we're going to be covering our major technical analysis recap on our major market indexes, encapsulate what happened during the regular hours and in the after hours if we were to open like this tomorrow, and then wrap it all off with a analysis as well of all our major big tech names, see where those are too, and see whether some or all of them are still in very good buy conditions for long-term portfolios or possibly for some trades as well. So we got a lot to cover today, guys. Let's jump right into the action, shall we? So the SPY today down 0.84%, the Q's down 0.93%, but you can see that that was largely recaptured in the after hours. Remains to be seen if that will hold overnight. In terms of the heat map, guys, well, you can pretty much tell from these sectors right here, it was not a very good day all across the board. Most of everything coming cleanly to the downside, namely healthcare, which got caught up in its own tariff rumors about sectoral tariffs possibly affecting the pharmaceutical industry, which is why most of your major pharmaceutical players were down 4 to 5% after that news. Now, big tech also didn't have that good time of a day today. Most of all the major big tech names were down. Banks were also down as well. And the bottom half defensive side of the market was additionally down. So a broad-based day of market rotation to the downside. You can see that even better in the one-day relative, where the only green spot in the market was utilities, followed by basic materials, but we never really talk about that so much. To the downside, major fashion was healthcare, of course, after those sectoral tariffs were possibly announced or hinted at to be rolled out maybe within the next 30 days as the US tries to reshore a lot of its pharmaceutical production, which most of which now comes out of either India or China combined, and everything else to the downside for the day. So that is everything that you had for the day. We are still sitting in an atmosphere of market greed after the market is pushed up 2 very clean weeks in a row. But now we are kind of trapped in an area where it raises the question, right? Can we mount over and above this level that's been challenging and really push into further resistance? Or is this just another cue for a possible movement to the downside into further weekly consolidation? We'll take a look at a bit more of that when we look at the charts a bit later. But before we do that, let us dive into the first set of earnings, which is going to be from Celcius Holdings. So taking a look at good old CELH right here, in terms of their earnings, they had them before the open today. Initially, they had dropped after those earnings, but put in a very nice recovery from the pre-market all the way to the tops of the market today. 20% recovery. I know it only says 5 there, but from the pre-morning drop rather, all the way through the close, it was a very nice recovery by CELH. Now, CELH has been somewhat resilient in the face of tariffs. You can see that ever since Liberation Day on the 4th of April, the stock has largely traded sideways, with some upside recapture, of course, but largely sideways, not really dropping with the rest of the market. Maybe because the stock is already down 70+% from its all-time highs, and it was all down to this earnings. Would CELH, after being flat in terms of revenue for the past 7-8 quarters, would they be able to break that flat streak of revenue? And the answer, unfortunately, was no, not really. So take a look at their earnings right here. EPS miss by 23% and a miss as well on revenue by 3.86. Let us dive into their earnings slides directly, and then I'll give some commentary as of whether or not this one is a buy. So taking a look at the commentary from the CEO, Celcius navigated a dynamic operating environment in the first quarter while continuing to invest in our core brand, product innovation, and operational scale. We saw business fundamentals strengthen through the quarter and are encouraged by the positive momentum heading into Q2. With the Alani Nu acquisition now closed, keep in mind they did buy Alani for $1.8 billion, continued gains in retail shelf space, they continue to gain market share, but ever so incrementally, and strong international growth across both legacy and new markets. We are confident in our growth strategy, and we believe that we are well positioned as a leader in modern energy drinks. So that being said, guys, I will remind you what happened with Celcius Holdings. They had absolutely phenomenal growth. We're taking leaps and bounds in terms of market share, and the revenue was really scaling rapidly. All of that started eroding in the early stages of 2024. This dip is a result of market share grabs peaking, topping out. They're still gaining share, but the gains are incrementally slower right now. And the same thing for revenue. The revenue is still gaining, but it's not doing this anymore. It's doing kind of this, right? The NVIDIA effect. So that's why the stock has been selling off a ton. And that's why we need to analyze, is it possibly a time for a pivot point? Is it remaining a buy right now? For the reporting period, Celcius held market share across key international markets as follows. USA is good. They've been expanding internationally well, which we'll look at very briefly. But here's the thing, right? Sweden, 13.5% market share. Finland, only 6. New Zealand, 4.5. Canada, 4. Australia, 2.5. Ireland, 1.2. France, 0.6. And Great Britain, 0.2. So as you can see, right, they're not really a dominant player internationally. And the international segment of their revenue is a very small portion of their business. Let's take a look at those slides and I'll show you what I mean. So here's their nice little picture with their newly acquired brand, Alani Beverages, for $1.8 billion overall. And as we can see right here, guys, they're highlighting that they do have still gross margins of 50.2%. Now, Celcius Holdings has never really had a problem with maintaining gross margins. The problem for them is that they've never really been able to consistently bring that to the bottom line. Here you can see the gross margins are fairly consistent around 50% for the last 7 quarters. But look at the operating margins, right? They've dwindled into the negative territory, and even net margins have dwindled from very nicely positive down to negative as they spend more and more money on promotional campaigns to really get the brand awareness out there. So they forfeited a lot of the positive net margins that they had previously in the last year, and now are operating at a slight loss. That being said, this quarter was not a loss. They came back to a positive territory. They're now sitting for this quarter at 13.4% net margins. Let's continue, shall we? So overall, you will see that they do have several nice gains, but several places where there are pain points here. Revenue for revenue right here, down 7% year over year from the quarter 1 2024 to 2025. North America down 10%. That is their biggest market, guys. It's 93% of all sales. That was down 10%. International was up 41%, but keep in mind, it's a very small portion of their business, only up roughly $6 million. That's not going to move the bottom line so much. Gross margin was maintained, as we can see. Net income was a nice little beat in terms of a nice loss rather, but still a positive territory. It was a nice little beat over last quarter, which we don't see right here, which was negative, but a loss year over year by about 43%. Once again, showing that they are struggling to maintain that net income. And of course, when your net income is struggling, well, your EPS is going to struggle as well, largely a factor in which they missed their EPS. Now, here you go. CELH total retail sales across their tracked channels. You can see that, yes, CELH and the Alani brands are doing very well in terms of retail sales. That's increasing. CELH contribution to the category overall in terms of the energy drink space is increasing. But I'll remind you, they're not only competing against Red Bull and Monster here, they're competing against every single caffeinated beverage. There are several other smaller energy drinks, but there are also coffee drinks and other caffeinated beverages that they do have to compete against as well. The caffeinated beverage space is a very hot market right now, no pun intended, because some are cold and some are hot. You know, Celcius is cold and Starbucks is hot. Anyways, I digress. But here we go, right? So a lot of competition in this. Retail sales. Now, here's a little trick they play on you. They show it you month by month to show that it has been upticking, but that's what you would want to see if you're looking for an inflection point on CELH, because to be quite frank with you, when we look at some graphs later on below, you'll notice that, unfortunately, guys, their sales have been flat now for roughly 7 quarters. But now in the last 3 months, they have been upticking both in the Alani brands, which is in blue, and also in the CELH, Celcius Holding brands overall. So now you can see the total share of market share from Celcius Holdings is right down there at 16.2%, but it is somewhat flatlining. Monster at 27.6 and Red Bull at 37.1. Now here's your energy MULO plus WC dollar share. That's a very fancy acronym for saying convenience stores, gas station stores, and just, you know, the corner store niche of this market right now. The black line is CELH combined. The blue dotted line down below is Alani. The orange is CELH. And above you, of course, you have Monster, and the top leader is Red Bull. Now, they were losing market share progressively, but you can see that that loss of market share has stalled, and Red Bull has actually gained back what they have lost. So we can see that the gains were really pronounced here 2022 through 2023, which gave CELH stock a huge lift as people thought that possibly they were going to take over the entire energy drink space. But we know that it's not that simple. With legacy players such as Red Bull and Monster, well, that might be more difficult to achieve. So one question that we have to ask ourselves is this CELH's total addressable market, or are they possibly getting peak or close to the peak of their total capacity to obtain market share? These are all very valid questions, keep in mind. Now, here's your consolidated revenue. This is by quarter. Here's what you can see, right? For the past 7 quarters right now, 8 quarters, it's been flat. No more expansion. When you measure year over year, sometimes you can find some easier comparables from one quarter to another, but the demographic of this chart is very clear, right? The distribution, rather. It has been flat for the last 7-8 quarters, which is why the stock price has not moved at all. Now, international sales has been a very nice point for the brand, but as I said before, this is only a small portion of the revenue, guys. Of course, it might scale up in the future, but internationally, arguably, they face even more competition than they do domestically. So it remains to be seen how much international presence they can actually gain. Now, gross profit margins, as I said, was never truly a problem, always maintaining above the 50% range. It's just that they cannot bring a lot of that down to the bottom line. So that is everything for Celcius Holdings, guys. In terms of the Alani purchase, I mean, it did cost them shares, which you cannot see in terms of the diluted share count right here. This is their shares outstanding. You can see that they did dilute shareholders a little bit with stock-based comp, and then the Alani acquisition, which was done partly in cash, but also partly in stock as well. We do have to recall that Pepsi does retain a distribution deal with the brand and owns approximately 8.5% of the entire company. That is still a bullish point in my humble opinion. Now, in terms of the growth moving forward here, guys, you can see that it is slightly skewed. We have a nice EPS gain, but some of that is coming from Alani. That will be moving up and to the right, which is a good sign for the brand. That's been struggling in the past 2 years to keep things consistent. In terms of revenue, you can see a very large increase here, but once again, that is because of the addition of the Alani brand of drinks to their portfolio. As we can see, though, the past 2 years was flat. Now it will be increasing, but not increasing at the same pace as we saw from 2020 through 2023. However, the one bright spot about the company is the fact that they do not really have that much debt to speak of overall, even though they did pay almost a all cash and stock deal for Alani. On their balance sheet is currently sitting roughly $900 million of cash and cash equivalents and a decent amount of free cash flow. So all things are good in terms of their balance sheet. Now, is this company a buy right here in terms of their quote unquote recovery story? Well, nothing really ever happened. It's just that they stopped growing at the crazy metrics that we had just a few short years ago. But if we want to extrapolate a possible future share price for the company, we could do a couple little things surrounding price to sales. At $35 right now, guys, they're sitting at a 35 forward price to earnings with an EPS of $1 for this year. They're sitting at a 1.4 peg, which is not bad, all things considered. I'll remind you, anything under 1 is cheap. Between 1 and 2 is okay. Above 2 starts to get a bit expensive. And price to sales sales of 4.29. That is not bad, guys. Monster Beverage sitting right here at 7.25 price to sales on average at $60. And keep in mind, Monster itself is indeed back to its own relative all-time highs. So even that number there is a bit inflated because the company is at the all-time highs. Monster usually trades between like a 5 and a 6.5 forward price to sales. So CLH, you can argue that, yes, they're under, but are they under the industry by a factor of 2 or more? Probably not, right? But if you want to know if you're interested in this stock for maybe the next 4 or 5 years, right? We can take something like a forward revenue number for them, and they give it to us down here, roughly $3 billion. Now, let's say I'll be very generous and give them a 5 to 6 forward price to sales, yeah? So we'll take a midpoint here of about 5.5. If I do 5.5 times that 3.1 billion in terms of sales in 2028, you're looking at a forward market cap roughly of about $17 billion. That would roughly be a 2x from here, right? Not so crazy overall. However, right, so that would mean roughly a 2x from the current stock price from roughly 35 to 70. However, if you want to see them go higher than $90, you have to stretch the valuation. And of course, two things can lead to a stock price appreciation. Either the fundamentals are drastically going to improve, while the metrics that Wall Street attributes to the stock, such as price to sales and allowable multiples in terms of earnings that it can trade at, right? Either one of two things has to expand, the multiple or the actual fundamentals, right? If you stretch this one a lot and give them like a 7.5 price to sales, or even a 10, let's say, where they were trading at prior, if you were to stretch it and give them a 7.5 price to sales, and then you do the 2028 sales numbers, that would be a $23 billion market cap divided by 9.15 right now. That's roughly a 2.5x from here. So you maybe be looking at something like kind of back to that $80, $90 range, right? So that would be fundamentally a price point for the company in the future. So as we can see, there is share price appreciation for the company, but they have to keep executing. They have to continuously have positive net margins, and they have to continuously be able to raise their quarter-over-quarter revenues, which have been flat for the past 7 quarters. Now, CLH for me would be maybe a 1% position, 2% position. I wouldn't mind trading it, but at the end of the day, it's a company that faces a lot of competition, both from legacy players in the space, bigger players in the space, such as Monster and Red Bull, and also faces competition from the entire rest of the caffeinated beverage landscape, but we can possibly see some upside. Suffice to say that when the stock has been de-risked as much as it has been, 35 down to roughly 25 bucks is not a bad area to accumulate some shares if you're looking for a longer term play on CELH. And that's everything I had to say about that company. Company number 2 is going to be a bigger one, guys. Now we're going to take a look at AMD. Now there's been a lot of I wouldn't say controversy, but there's been a lot of impatience surrounding AMD, right? They were supposed to follow in NVIDIA's footsteps, but ever since the last 6 months, they've done nothing but fall off a cliff as people impatiently wait for the data center ramp to actually happen for the company. That being said, AMD right now is up 1.1% in the after hours, so their earnings were kind of a flop. I mean, they kind of oscillated around. Initially, they went up 5, then somewhat, not negative comments, but just lack of bullishness from Lisa Su on the earnings call led to the stock dropping that entire move and then ending pretty much where it started in the early portion of the after hours. In terms of their numbers though, guys, I got to give it to them, okay? They actually had a very decent quarter. They beat on EPS by 1.64%. They beat on revenue by 4.4%. But the problem is that it wasn't the substantial beat that people were looking for. Their numbers were good, but they roughly came in line with the expectation. So when I give you all these crazy numbers like revenues up 36% and data center sales up 60%, keep in mind, right? That was the expectation. You may remember me showing you these charts for a very long time now at this point in terms of how 2025, 26, 27 were going to be their best years for EPS expansion and for revenue expansion. So we knew they were going to have those growth numbers. We were just looking to see, could they maybe beat them? And unfortunately, not by so much. So let's have a look right here. You can see operating margins for the company have oscillated, but roughly sitting right now at the mid 20% range, which is good, but a far cry from NVIDIA's. Revenue was up 36% year over year. Data centers were up 60% year over year. Not as good as Q4, but for a Q1 showing, that's fantastic for the company overall. Operating income was up 57% as well, and EPS a nice little bump, a nice little boost or bump of 55% year over year. Let's get into the article, shall we? So AMD earnings beat as overall sales surge 36%. Very nice for them overall, guys. Let's take a look right here, yeah? So it topped expectations, and they did provide a strong forecast for the current quarter revenue. So a double beat and a raise, but it was not enough. It just wasn't sexy enough for AMD, unfortunately. For the current quarter, AMD expects about $7.4 billion in sales with a gross margin of 43%. That is versus the expectation of $7.25 billion. So they did guide higher, but not by that much. But it is very nice to see them do a double beat and raise. AMD CEO Lisa Su said that the company achieved its first quarter results despite grappling regulations on advanced AI chip exports, of course, talking about China. The company forecast also included $800 million in costs that the company said it would incur because the US limited the export of some of the company's artificial intelligence chips during the quarter. Su said AMD faced some challenges related to tariffs. Now, this brings me into a parallel of something else we had today. I'll go over it a bit later too. Actually, you know what? I'll do it right now. It's what Jensen Huang had to say. Now, we very rarely get a glimpse into Jensen Huang in terms of interviews outside of the context of either CES events or earnings presentations, right? But here's what he had to say about the entire export restriction scheme that the US is placing on exports towards China. Jensen Huang today said that being locked out of China AI market would be a tremendous loss. Let us get the American AI out in front of everybody right now. He was on this interview, and word for word, he pretty much almost said, well, I'll, paraphrase right here. He said, you know what? Let us compete. If they want to compete, let us compete, because China's going to do it anyways. They're going to ramp AI anyways, but let us compete with Huawei. If you guys want to compete, we'll show them the good American way, who can possibly design and utilize these things better. That was his message, and I've said that a lot on the channel as well. I understand the United States is trying to protect its national interests in terms of intellectual property and in terms of defense purposes as well, but Jensen Huang is very firm on wanting to actually compete with China, being able to give them the best of the best and penetrate that market. It's a huge market for them, guys. $50 billion in terms of market overall. And that would also be very big for AMD. Now, moving on further, while we face some headwinds from the dynamic macro and regulatory environments, including the recently announced export controls for their chip shipments to China, we believe they are more than offset by the powerful tailwinds from our leadership product portfolio. So saying that although they have some headwinds from the macro situation right now, they feel that they have enough juice that will kind of counterbalance the impacts of the macro. Now, the company reported a net income of $709 million, which was okay, 9.5% net margins, but AMD's net margins, guys, they just have not been consistent. And this has been one of my biggest criticisms of the company. Gross margins are improving, but every quarter, the net margins just fluctuate so darn much as their operating margins fluctuate so darn much, right? It's kind of slightly annoying that they're not able to push above 10% net margins and stay there. I understand they have many different lines of businesses, but so do many other companies here. Data center sales were up 57% on an annual basis. The depth and breadth of our customer engagements continues to expand as breakthroughs in large-scale AI models like OpenAI's O3 and DeepSeek R1 drive increased demand. So reiterating what a lot of other people have said, Google said this, Microsoft said this, NVIDIA said this, that although there are different language models competing right now and different AI models competing, that's just going to drive up overall demand so that everybody wants one in the end, right? The company's other major segment, client and gaming, which has been somewhat rough as of recently, rose 28% on an annual basis to 2.9%. AMD said its sales for laptops and PC chips, which it calls client revenue, surged 68% year over year. That's the client segment of client and gaming. What about gaming though? Well, gaming sales, however, declined 30% on an annual basis, which the company attributed to a decrease in console chip revenue. We saw that a few quarters ago as well. So client and gaming, a bit of a mixed bag, up 28% as a segment overall, but one division, client, performed well, and the gaming segment did not, unfortunately, which brings me into a bit more slides here. You can see the data center revenue is nice up and to the right. That's exactly what you want to see. It is now their most profitable line of business and their fastest growing line of business. So you got to pay attention to this. Down from Q4, but leaps and bounds above last quarter Q1. Here are their KPIs. So in terms of the sales year over year comparisons, the blue is data centers. You can see a clear ramp in data centers. The purple right there is client revenue, as we've been talking about. That is up and to the right. But look at gaming, man. Gaming has been struggling for literally the past 3 years. Not only them, even NVIDIA gaming segment has been struggling, right? Graphics cards, and personalized compute CPUs as well. It's just been struggling, that segment overall, as we still continue to see a lull in demand for those products. There was a huge pull forward 2021, 2022, and then it's just been down, down, down ever since, as consumers are really stringent with their budgets right now. We could go through a few earnings slides for AMD, but you'll kind of find it's pretty much more of the same. Record revenue Q1 is very good. Gross margins are being maintained, but as I said, and maintaining and increasing gross margins are fine, but if you can't consistently bring those to the bottom line, it's just going to oscillate quarter by quarter, right? Operating income was higher than it was at this time last year as well. And overall, we pretty much went through everything else, right? We went through the segment results, summary of the balance sheet items as well. Cash and cash equivalents is at a net high right now, 7.3 billion. AMD has never really had a problem that much overall with debt. They've always been able to have at least more cash than they do have debt, but nice to see their cash pile is now to about 7 billion. And the company does bring in a decent amount of free cash flow per year. So nothing really bad to say about that. They do still have a lot of inventories though. A lot of that will be reduced. But as I said, the client and gaming segments, guys, are just not moving at the speed that you would really want to see for this company overall. And that's pretty much everything. I've pretty much done a very good job of covering everything overall. So we'll just move into the actual valuation of the stock, right? So we know, of course, that the thesis for this one was expansion of the EPS metric and the expansion of the revenue metric in an exponential fashion because of that data center segment. Well, that thesis is still largely on the table, right? Nothing has slowed down, and AMD did beat their metrics today and even guide a bit higher, despite being a bit slowed down or facing some headwinds because of all the export controls into China, which is a very big market, as reiterated by Jensen Huang himself today, right? So where do they stand right now? At $102 in the after hours. They traded a forward 23.12 price to earnings, which is relatively cheap for this company. They're also growing EPS at a record rate of 30% per year for the next 3 years. That gives them a PEG ratio of 0.77. Very cheap, and a forward price to sales of 5.16. This is also extremely cheap, guys. This just means that this stock can literally 2x and would only be a 1.5 PEG and a 10 price to sales. It could 2x to $200, guys, and still somewhat be cheap in terms of the revenue and growth that they're bringing in for the next 3 years. So my thesis remains the same. This stock is one that either people like or just don't like, because some people even call it advanced money destroyer, right? It'll never be NVIDIA, but will they be able to, take away some market share and carve away 7, 8, 9% of market share for data centers? Quite likely. And they've been giving Intel, everybody knows this, they're giving Intel a run for its money, guys, in terms of the personal compute segment, and even so in the server segment for CPU architecture, both enterprise and also client side as well. So that segment has been growing despite it being in a cyclical lull right now, but that's not always going to be the case. I do think when there's a big consumer refresh cycle on the horizon, AMD stands to capitalize. So for me, it does remain a buy, but I would pace my buys here patiently now and anytime we could hit the lows, possibly from the macro headwinds of all the tariffs or headline risk, or just because the markets overall have another wave 2 leg down. I wouldn't mind it down here. The long-term thesis for me, this would be a hold for the next 2-3 years as I seek for them to really play out in that thesis and grow into the valuation that could be deserving for this stock. 130, 140, 150 would be fair, but even up to 200, guys, I mean, I know it sounds like a long shot, right? But the valuation would not be so crazy, especially in comparison with several other stocks. So that's going to be my formal price targets for my shares that I've been building down here. 150, $200 over the next 2-3 years could be possible, but it is going to need the support of an overall bull market, right? So that's everything for AMD. Hopefully you guys enjoyed that. Now, company number 3 that we're going to be covering today is going to be ANET. So ANET is one that I very rarely talk on the channel, but it's an extremely high quality company. Company does networking and software applications, not only for data centers, but for big enterprise projects. It's one of the companies with some of the most solid fundamentals that you can possibly find in the market in their respective niche, guys. ANET, super strong company. Let me introduce you to it. Revenue up and to the right. Look at these net profit margins over the last few quarters. They've grown from a few years ago. They were already good at 28, 30%. Now they're all the way in the 40% range. It's very tough for a company that produces products. They also sell software, but for a company to do that, that is phenomenal. That's like TSM net margins, right? In terms of their forecast here, you can see that EPS steady up and to the right, which is what I like to find in a company that's really growing within its own niche and taking market share from competitors. They are arguably the industry leader in what they do, but there are other players below them, and they continuously take market share from the players below them, and even their revenue line looks very good in terms of expansion for the next few years. In terms of their balance sheet as well, you really have nothing bad to say about this company. They make so much profit. Debt is not virtually non-existent for the company. Decent free cash flow and a decent stack of cash on the balance sheet. So balance sheet definitely gets an A+ from me. Now let's take a look. What happened with their earnings, guys? Well, as you can see, they were down 5.64% in the after hours. Why? Well, unfortunately, it has to do with the tariffs. These fundamentals are super solid, but why are they down 5? They literally gave guidance that they were dropping their operating margins and gross margins by a fraction of a percentage point, and that was enough for them to get sent down. But keep in mind, when we're going to look at the valuation, it does trade rich. So every one of those profit margin metrics does matter more than you would think, especially when you trade a bit rich. So earnings up, EPS up by about 10.23%. That was a beat, and revenue was a 1.9% beat as well. Let's take a look at some of the numbers from Arista Networks, and I'll tell you what I mean, how solid of a company this is. So now you have a company that is the #1 market share in data center switching and networking capacity. They've grown into that position, guys, over the last roughly 4 or 5 years. So the company has been operating for a very long time overall. Let's move into it further here. You can see they have a 5-year compound annual growth rate of revenue of almost 24%, which is fantastic. Gross margins of the last 12 months was 64.5%. Keep in mind these gross and operating margins when we take a look at their guidance, and I'll show you why the stock dropped right now, right? $70 billion in total addressable market. Also something that I'm looking for when I'm looking to find some of these top quality companies that still have a very high ceiling that they can possibly grow into, right? Solid management team as well. Got to give them that. Now let's take a look down here. All 3 of their segments are growing and growing well. Core is the data center and cloud networks, the dark blue down there. You can see it's growing. Cognitive agency, campus and routing services, that is also growing nicely. And the cognitive network software and services, the green, is also growing very nicely. So looking pretty good, guys, trying to grow into that TAM. This is from this year all the way through 2028 is their supposed total addressable market, looking very good there. You can see that most data center Ethernet switch revenue is also growing, and they are taking more and more market share, as we'll see from the slide down below. They're getting faster and faster in terms of what they can do to provide these data centers with the fastest network for the fastest amount of data transfers. They are the market leader, and they push the boundaries. And if you go on forums such as Reddit or other locations, right, where you would find reviews from engineers who actually use ANET products in the context of data centers, the uniform review of ANET is that their products are extremely solid and extremely easy to work with. That is a qualitative thing that I also like to hear from experts in the industry. When they love to use the product, it just gives the stock an extra little bonus, right? Or the company, rather. Now, they are delivering consistent market share gains versus a prior industry leader in the name of Cisco. As you can see, the share in dollars is now completely flipping Arista with more, and share in ports overall, Arista is now taking over Cisco's previously dominant market share. I mean, Cisco's come down from high 70s. And now they're getting their lunch eaten by this fantastic company overall. And Arista Networks market leadership, you can see that. They're now dominating 43%. Their next competition is a company called ROM. And then you have Cisco up here at 14%, which, they've been, ROM has been gaining as well, but Arista Networks also 43%. So in terms of their networking capacities, high-speed Ethernet ports, well, they are doing very well overall. Nothing bad to say about the company overall, guys. Gross margin, you can see 64.1, operating almost 48. Keep these numbers in mind, 64 and 48. Why does it matter? Well, I'll show you why it matters. Because of the guidance, yeah? Gross margin now, 63. Now, they're dropping for Q2 by 1%. The stock's down 5%. Operating margins, they're dropping by about 1.5% roughly to 46% from all the way up here, right? 47.8. Well, the stock's now down 5%. Only for that, guys. But it does matter a little bit when the past 5 quarters you've shown gross margins in the 64s, and now you're guiding for 63. Although your total revenue is going up, your operating margins as well. You've been sitting in the 47 to even one quarter 49, and now you're guiding slightly lower than that at 46. All of that does have an impact overall on the company in terms of earnings, but that is the only thing Literally the only thing, guys, that you could possibly pick apart from this almost pristine earnings report. Now, cash from operations was very good. You saw they did $781 million of share repurchases, right above my big head in terms of that. So they continue to buy back shares with their very strong balance sheet overall. And that is pretty much everything that we're looking at for Arista Networks. One little comment here from the earnings call surrounding those operating margins. It's because of the tariffs, guys, right? It's all because of the tariffs. I did a control F to find the word tariffs. 29 mentions of the word tariffs in this earnings report. Here's what the CEO had to say. We are absorbing whatever tariffs we do have to deal with from China and other things. But should that change, we expect it to have some effect. That Chantel, she's down below here, alluded to in our gross margins that we've taken into consideration for the year. And some we will absorb. Some we may potentially have to pass to our customers, but the customers will pay because it's the industry-leading software and networking services, but we don't know what we don't know, so we can just go at this one quarter at a time, unfortunately, were the comments by them. So if you were to take those commitments, that puts us in the range of gross tariff impact to be 1 to 1.5 points at the top layer, talking about gross margins. And worst case scenario, right? There may be a point to where we have to have the price increases, but we're looking to mitigate that through absorption and tariff and supply chain fungibility. And that is reflected in the decreasing margins that the company has provided guidance for Q2. So pristine earnings, guys. But once again, tariffs. Even in this company, which is expanding revenue so well at such a high compound annual growth rate, just the mentions of tariffs were enough to bring the stock down almost 5% in the after hours. Still a very fantastic company, though. So at 83 bucks, guys, is it a buy right now? Well, now they're at 86, but I mean, let's just take 83, yeah, because they were just there pretty much. At 83 bucks, they're currently trading at a 32 forward price to earnings. Bit expensive, although they are growing EPS very quickly. That gives them a ratio of about a 2 peg right now, which is a bit high. But as I've been saying to you guys many times, when you look at companies like either Visa or Microsoft or other companies, right, that have very consistent business models and that are growing very steadily and that have high competitive advantages within their industries, Wall Street allows them to trade a little bit rich. That's why this company has been trading rich largely for the past 2.5 years at this point, as they continuously prove why they deserve that valuation. The free cash flow yield is a bit low at 3.2%, and the price to sales at 13.6 is a bit high, right? This just looks like a CrowdStrike or something like that, right? A fast-growing tech company overall that is a dominant player in its space with really good fundamentals. This one especially kind of mimics TSM in the fact that it has 40% net margins, and so Wall Street does give it the benefit of the doubt to allow it to trade somewhat more rich than some of its competitors. Is it a buy right now? Well, there's a few other metrics that you got to keep in mind. What happens when you give $1 to Arista Networks? Are they good at managing that capital? They have extremely high return on invested capital and return on capital employed. You don't hear me talking about this a lot, but when they're as stellar as they are for ANET, I mean, geez, guys, like these are very strong numbers. Look at this. Return on equity, 33. Return on invested capital, a 54, which is nuts. And return on capital employed, 30. So every dollar the company receives, right, either through its business or through shareholder investment, they're able to allocate that capital and drive revenue for the company and drive profits to the bottom line as well. They're efficient at managing their capital. That's why they have such a high profitability rank overall. So that is another consideration for this company. Very, very, very strong company overall. So here, is it a buy, guys? I wouldn't mind. I've been playing it a few times overall. I wouldn't say that this is something that, you know, I'd put in my long-term portfolio at a 5, 6, 7, 8% weighting, but it can deserve a place if this is the style of play that you like. It definitely deserves a second look, of course. And if we do find it ever again back in the lower $80 to $70 range, the valuation will be very manageable at that point. They'll be coming back to last April. And I do think that that would represent a pretty decent buying opportunity for this fantastic company that still has a lot of total addressable market to grow into. That is everything for Arista Networks. Hopefully you enjoyed that one. And now lastly, but not least, we're going to do a fun one that everybody understands. Ferrari. So taking a look at Ferrari stock over the past, let's say 10 years since they've been public, you can see that they are no stranger to gains. This is actually one of my two favorite pure form car manufacturers in the world, the other one being Toyota. So I'm really going for the two opposite ends of the spectrum, right? The most reliable cars and the ones that are most budget friendly, such as Toyotas. And then to the top end, Ferrari, right? Two completely different car companies with two very different business models. But Ferrari definitely deserves a second look because I don't talk about it much on the channel, but it's a very, very high quality company. And also why they do deserve, kind of like ANET, a higher than normal valuation than you would see otherwise with other car manufacturers, and we're going to explain why. Let's take a look at some of their numbers, because the stock was up after their earnings today, 1.65%. They've had a very nice rally from the bottom of the tariff lows of about 20%. Let's take a look at some of their numbers, because very rarely in the past few years has Ferrari ever missed their earnings, and this time was no different. Let's have a look right here. 0.83% beat on EPS, and a 1% bump on revenue. And I'll start it off with a quote from Enzo Ferrari himself, guys, by saying, Ferrari will always deliver one car less than the market demand. This is the advantage that Ferrari has. They go for a business model that is quality over quantity, delivering limited edition models, most of which require a wait list, or you have to be a prior Ferrari owner to even have access to in the first place. So they really do a good job, guys, of cornering that demand, right? Doing limited edition models, and a lot more people want the Ferrari cars than they actually have. AKA, you can derive from that the company has a lot of pricing power overall, yeah? Speaking about that pricing power, you can see that from this comparison here between Ferrari, Porsche, and Mercedes-Benz. Ferrari with insane gross margins, over 50% right now. Porsche, although a very other solid brand in terms of the high-end luxury performance cars, 25 to 29% in 2023, and Mercedes-Benz only at 21%. So that is Ferrari's pricing power overall, which goes to reiterate the fact that maybe a few weeks ago, in response to the auto tariffs, you guys saw that Ferrari was able to increase their prices by 10%, and they know that they're probably not going to lose a single customer. It's a luxury product. People that buy Ferraris have a ton of money. And trust me when I say, if they want the new releases and the limited edition models, they will definitely pay that extra 10%. Let's move on to a little bit of an article here. Ferrari starts the year with racing profit, pun intended, but warns of tariff impact. So the Italian luxury car maker reported a robust first quarter with a 17% increase in its net profit. Fantastic. For the first 3 months, slightly better than expected. The car maker also warned that U.S. trade tariffs could hit earnings later this year, and that is with possible price increases. Will it be enough? We'll go to see that. However, the car maker warned that this profit could be reduced if the U.S. tariffs hit the car maker harder than expected. So they did do a 10% price increase, but they said that, if tariffs are going to be worse than that, maybe it's not going to be enough to safe haven those profits. The above guidance is subject to a potential risk of 50 basis points reduction on profitability percentage margins. Not by much overall here, guys. They were guiding for revenue bumps of 5% year over year and adjusted operating profits by 7% or more, saying that there might be a 0.5% impact if ever the tariff impact was larger than expected, right? Now, moving on further, at the end of March, Ferrari also already announced it would increase the prices for certain models up to 10% in response to the 25% auto tariffs from Trump on the European car imports overall. Let's take a look at some of their slides right here, and you'll see fantastic car manufacturer, guys. And I really like their slides too. They unveiled the new 296 Speciale and the 296 Speciale there. These little cars right there, they're looking very nice overall. And they introduced it to us with the nice old SF90, of course. Gotta do that, you know what I mean? So take a look at the shipments right here, guys. Shipments, fantastic for Ferrari overall, guys. They always usually beat on their shipment numbers because, they always try to do this, right? So they always know quality over quantity overall, and they do beat their shipments overall. Net revenues, a nice beat, 13% year over year. Earnings per share, 18%. Free cash flow, a nice little increase there by 93% to 620 million euros overall. A nice beat on EBIT and EBITDA margins as well. So very solid there in terms of everything as well. If we additionally take a look at some of their guidance that they have, well, they're going to be obviously getting out those 6 new models, including the Ferrari Electrica, which should be a very fun model to come out. Their all-electric version of the Ferrari, of course. Now, net revenues for 2025 should be 7% overall, but you keep in mind, they did say that it could be off by 0.5 percentage point if the tariff impacts are wider than expected. EBITDA margins as well should be roughly what they were last year, so no change there, excuse me. And in terms of adjusted EPS, that'll also be higher by roughly 2%. And the free cash flow, they are expecting free cash flow per share to be up by a whole 17% overall. So very, very, very strong, guys. Continuous brand investments, higher racing and digital transformation expenses were some of the criteria where you might not see that much lift in terms of operating margins, but so solid overall from such a very strong company, guys. The appeal of the brand is very clear. Their competitive advantage is very clear as well. And if we just move on to a few short little more slides, I mean, we got some nice Ferrari pictures there. They're very nice overall. So we can see here that they do provide a nice little timetable of the new models that they introduce. We can see that this year they'll be introducing a couple of new models overall, and they break it down by differentiation of either supercar, track car, special series, etc., etc., etc. The one thing I wanted to bring you guys' attention to is group shipments by region. Now, this isn't necessarily because their sales are dwindling or whatnot. We can see that in mainland China and Hong Kong and the rest of Asia Pacific, which are the either light gray for mainland China, Hong Kong, and Taiwan, were down. The rest of Asia Pacific was down as well. Americas was up, and Europe, Middle East, and Africa was also up and to the right. That's not necessarily because these markets are performing poorly. It's just they only have a certain allocation of cars per year, and it's up to the brand how they want to decide to allocate those cars per segment, because every single one of their new cars always sells out, guys. It just depends where they want to allocate those batches to certain which customers, right? So overall, the company is very solid, and you can also see in terms of their net cash and cash equivalents right here, if you follow my mouse, very solid. They've been building a nice cash reserve pile, currently now almost at $2 billion, about 1.9 billion in cash reserves. So phenomenal company, right? The pricing strategy is perfect by Ferrari at this point in time, in my humble opinion. And overall, just a very solid company altogether. Now, in terms of their expansion, which is something that we always want to check at, so we can see that their expansion, they've been expanding net margins very nicely, and that will still continue moving forward, as they do have as much pricing power as they possibly want to mitigate the impact of any costs, right? They will protect those margins just by increasing prices, and in my opinion, customers will pay. EPS steady up and to the right, which is exactly what you want to see, and revenue steady up and to the right, which is exactly what you want to see as well. Going further into it, we have a projection slide up here from Ferrari revenues, and as you can see, guys, if I move myself to the middle now, so you can see the last columns here, all throughout, what have they been doing? Increasing sales, increasing the yellow bars, which is operating margin, and that will be continuously moving up and to the right, increasing net income. Their net margin line, which is this line right here, as you can see, that has expanded from earlier in the mid 2015 range from under 15% to now almost the mid 25% range. And operating margins as well have been steadily moving up and to the right as they benefit from that pricing power. So Ferrari, phenomenal company. It is a humble buy in my opinion, despite the valuation being a little bit rich right now. All the metrics are rich, but as we've been through this many times with other companies and other industries, when you have a player that is just so good at what they do, that has a defensible moat, a clear competitive advantage, and a clear demand for their products in any single market, because their target consumer doesn't really go in terms of fluctuations with the overall economic cycle, right? They cater to a very wealthy client, and those wealthy clients, those car collectors, they will always be buying Ferraris in the future. That's why all of their editions are sold out all the way through 2026. The order book, you can see right here, the order book is full through 2026 overall, and that probably will continue for a long time for Ferrari overall. So at $475 right now, they're trading at a 46.8 forward price to earnings. It's expensive. Nobody's lying. It's expensive here. The forward PEG ratio is also expensive. They had good growth, revenue, EPS, and the free cash flow yield is low because the share price right now is so high. But I do believe this one is a buy. Into technical support levels, it remains a buy. You can just go with long-standing areas of technical support. You know, when Ferrari usually dips into the 50 weekly moving average, it's usually synonymous with a good buying opportunity for a long-term company if you want to acquire some shares. That just happened a few times in the last 6 months. If we see it down again, maybe into support 426, 400, I may even pick up some shares myself. In terms of the valuation, you can see here, Guru Focus, which is arguably the best platform for this, they give it a score of 96 out of 100. They do say that right now it is modestly overvalued, giving it a fair value right now of $420, which is not so far below the current share price. It's about, 10% below. Profitability rank remains extremely strong. Return on equity, very good. Return on invested capital and return on capital employed, all very strong numbers, but you can see from the valuation, right? When you throw legacy valuation metrics at it, it says it's overvalued versus everything. But if you only look at this, you're missing the point. Wall Street gives higher valuations or allows these companies to trade more rich because of the fact that they have such a defensible competitive advantage. So those are my thoughts on Ferrari. Hopefully you enjoyed that. And with that, that wraps up all of our earnings for today. Now let's dive into some charts, shall we? So first, let's dive into the SPY. So the SPY was down 0.84% in regular trading and now getting a little bit of a pop in the after hours. However, we have not really cleared any major areas. We are still technically speaking in an area of daily consolidation and not quite clearing, right? I closed this box green because it did close above, but it was not a convincing close. That being said, if we continue consolidating to the downside and give away these moves from today, well, we're going to be looking for a higher low. Anything above 541, looking for a daily higher low on the SPY for possible daily uptrend continuation, but give too much of this back or roll this over, that's a daily downtrend. You're into weekly consolidation, looking for a higher low. Anything above 508.77, looking for a higher low for possible further trend continuation. We are battling two things right now. The positive news releases that you may see in the after hours or during regular market hours as we seek to get more trade deals on the table, approved, finalized, and then committed to the markets. And we're doing all of that while we are fighting on borrowed time. I will remind you of this timeline right here, published by Apollo Management just a few short weeks ago, which we have been seeing from several headlines from the port of LA, as we are seeing reduced shipping coming into the United States from foreign countries, mainly China. And the timeline is like this. The last container ships, all 35 of them, tariff exempt ones that is, are coming to port early mid-May. Then 1 to 10 days, truck and rail time to cities. That is the last filling up of those shelves for most of those products from China. Thereafter, you may face some empty shelves, and companies are going to respond to lower sales by doing two things, either trying to source products from elsewhere, or they're just not going to have any. And if they don't have any and they have lower sales and reduced sales, they're going to have layoffs, especially in the trucking and retail industry. And you don't have to take it from me, guys. I mean, the Port of LA has been very clear on this. They have been reiterating this. I mean, look at the headlines here, right? The trade is at China, right? The cargo is extremely light. I showed you guys these articles just a few short days ago overall, and that is just not stopping. So this, if you're looking for a volatility catalyst in the market, this is going to be the next one over the next 2 weeks. The media has not been focusing on it too much, but it only takes a few headlines of some layoffs here and there, some empty shelves here and there, and trust me, that's going to be felt in the market, and people will start talking about the recessionary narrative, even though they are now. It's like an oscillation curve, right? Sometimes it gets very high-pitched, then you kind of lose it with all the Trump deals and the tweets and stuff like that. But then if you actually get some hard data, well, then the sound of the recession will get louder and louder, and you will start to feel that in the market price. So that is what the market is battling with right now at these levels, right? So keep that in mind. Moving on to the Qs right now. So the Qs down 0.93 in the regular hours, but giving it all back, or taking it all back rather, in the post market. Now, clear a new high over the rest of the week. Perfect. Daily uptrend does continue, and we're looking for higher highs into resistance, 495 up to roughly 510. However, give all this back, take back too much of this move, looking for a higher low, anything above 463, looking for a higher low for possible further trend continuation, but take back too much and you might just roll this over. If you see a daily downtrend, you have to understand that you are into weekly consolidation, looking for a higher low, anything above 427, looking for a higher low. So what I'm saying right now, guys, is you don't know. You're trapped between two levels, resistance and below support. Wait for the price to come to you. I'm being very patient, not FOMOing the longs right here, because we know none of the macro has been solved just yet. And no longer do we have big tech earnings to save us either, right? So please keep that in mind. I'm being very patient. I'm waiting for dips to possibly place some short puts in or around some of the previous fear lows. Moving on to XLF right now, financials not looking too bad. So in the context of this nice daily uptrend right here with the higher lows being set, 47.5, any move lower looking for a higher low for possible further trend continuation. But take back too much of this move, you open up the door for the daily downtrend into support, which is 48.31 to 46.78, and you open up the door for weekly consolidation as well. Beautiful weekly uptrend, but eventually it can consolidate if the market narrative erodes. Anything above 45.19 will be looking for a higher low, and we will tackle that when we come to it. Moving on now to XLV Healthcare. So healthcare down about 0.63%. They really got thrashed around today with those news of the pharmaceutical headlines and sectoral tariffs, which could be affecting them in the next 30 days. That being said, daily downtrend is clearly in order for healthcare right now. And I was saying, guys, that we never really broke out, right? It's just been a very wide, volatile range overall. That volatility will continue. The one thing you don't want to see happen, though, is break one of two lows, 131.60 for the weekly uptrend. That will be gone. And then this one down here, unfortunately, you'd be heading a lot lower and possibly into the bottom end of the lows of 2021 through 2023. Healthcare supposed to be a defensive sector in light of economic contractions and stuff like that. But when you start talking about sectoral tariffs and stuff like that, I mean, keep in mind, right? Pharmaceuticals is a very large component of healthcare, and they have just been beaten down and beaten down and beaten down in the last 3-4 weeks. To some extent, look at Merck, right? I mean, it all started last July, but the tariffs definitely exacerbated it in February and onwards. And now even such a solid company like Merck, it doesn't really go down like this, guys. I mean, it did in the great financial crisis, and back then when it wasn't even close to the company it is today. But I mean, this one is down from its highs like 45, 50%, and the damage doesn't stop there, right? Eli Lilly has now come back down to the same place that they've been in the last year overall. AbbVie, another strong pharmaceutical player, has been coming down over the course of the day today, and many, many, many other companies, guys, are just they're not performing well, right? Johnson & Johnson's been stuck in this range for like 3 years at this point. So we're not getting any lift. Even a company like Vertex Pharmaceuticals, super solid player in pharmaceuticals, was down 10% after their own respective earnings overall. So keep all of that in mind. Pharmaceuticals has been the pain point on XLV, not to mention a very large component of the Dow and the S&P. UNH just been continuously down after their own respective earnings, which were not bad, but did show that they had rising medical costs, which will be addressed in 2026, but we covered that a few weeks ago. On to semiconductors right now. So semis down about 0.93% overall. That being said, we are looking for possibly a higher low on the daily. Keep that in mind, right? Still into resistance right now, 232 down to 213. Higher low is here, 203.64. If you come down too low, well, you end up opening the door maybe for the flush, the daily downtrend, and then you'd be looking for weekly consolidation. Still getting rejected at resistance right here. Anything above 184, looking for a higher low for possible further trend continuation. And unfortunately, some of the players, right, they just didn't perform today. AMD didn't perform. And even some of the other players, right? TSM's been on a very good rally. We'll take a look at that later. But a lot of semis right now are just pulling back. They cannot get the lift that they once deserved. They keep getting hit with tariff narratives left, right, and center. And I still do think that will plague the industry despite them having very strong fundamentals and guidance through 2025 and 2026. Now moving on to the Russell right now, 1.09%. You can see a clear daily uptrend on the Russell as well, and up about 0.81 in the after hours. We'll see, same as the other ones, right? Break the highs of last Friday, and you end up with a continuation of the daily uptrend, maybe able to blast through this resistance area and get to the next one, 208 up to 217. It's a big one, though. We still have not cleared this big range, so we'll see if we can do it. If we cannot, and put in a lower high and lower low, or just take back too much of this, and you see a daily downtrend, right? A failed uptrend continuation, in other words, well, you're going to be looking for a higher low on the weekly time frame, anything above 181, looking for a weekly higher low, possibly for some further trend continuation. I'd be waiting for a dip on growth to possibly farm some short puts in the lower end of that range down there. Lastly, moving into the Dow Jones. Dow Jones up about 0.95%. We will see how they open tomorrow, but daily uptrend is clear as day. Rejection from resistance 41.3 down to roughly 40,005. Overall, it is a solid area for the Dow Jones to try and breach through, and they have not breached it right just now, yeah? So the higher low is set at 39,800. If you move too low, or just are unable to break it and set the daily downtrend, you're looking at some weekly consolidation, same as the rest of the market, anything above 37.9, looking for a weekly higher low, then maybe a reset into support, then maybe going for the weekly uptrend overall. So everything looking a bit shaky right now after the last 2 weeks of rally. We really need those trade deals. Remains to be seen. Maybe Trump has a very big announcement, as he said, for us by the end of the week, and maybe that can help lift markets above their respective resistance ranges, because as you can see, the SPY hasn't really cleared it, right? We're still in it. The Qs, that's not the Qs. This is the Q. The Qs have cleared it, but still struggling. And another major index like the Dow Jones hasn't really cleared it just yet, right? Now, moving on further, we can take a look at the VIX. The VIX was up 5% overall today because of all of that push and pull between the tariff headlines overall. The VIX can stay sticky for a while when you're talking about economic uncertainty. You can see that now. You can see that back in 2022, see that back in the 2020 post-pandemic period. All of these, they stayed sticky for like months and months and months and months, guys, all the way back to tariff episode number 1. And also you can go back to the flash crash of 2011 or the great financial crisis to see whenever it's a question of a economic downturn or recession or whatnot, the volatility can stay elevated for longer than you may think. Moving on to the dollar index. The dollar index was actually somewhat flat today overall, but is still relatively weak, which raises the concern, right? Are people flocking back to the dollar? Not really, right? You're seeing a tremendous equity rally, but maybe all that is domestic. If there's truly foreign entities coming back into the dollar, rushing to buy dollars to either buy our bonds or buy US equities, well, the dollar should be a lot higher than it has been in the last few weeks. That has not happened. Are we going to see a rollover? Remains to be seen, but I will leave this on the chart until the bulls prove me wrong and recapture that 102 level that's been really, really fundamental for this chart overall, right? But it stands to argue, you know, as well, if the U.S. wants to be more competitive with its exports, well, it kind of needs a weaker dollar, right? So it's a lot of moving parts with the dollar as well. Moving on further, we can take a look at yields and bonds. So we had a good 10-year bond auction today, but still yields came a little bit lower, which was good because of that bond auction. But the reason I said, but still, we're still elevated, right? 4.3 is not cheap by any metric. Tomorrow, we get to hear from Jerome Powell on the direction of interest rates and his commentary. He's going to get asked 5 million questions about tariffs tomorrow. There's no way around it, right? How he answers them is going to be really the direction of the day in the afternoon. It's how he answers those reporters' questions because we're not expecting a rate cut just yet, right? So that being said, yields remain a very complex trade overall. Still roughly flat here on the 10, roughly flat on the 20. I keep saying it's a very complex trade. The one thing you do know for sure, though, is around 5% on the 20 and around 4.5 on the 10-year. You get a Trump put and a Fed put as well. Fed members will come out and say, we can backstop the market if we really want to, if the job market erodes. And Trump starts to put out a lot more deal news and starts talking a bit more nicely on those tariffs. That's the only thing we know about the direction of yields. And bonds, well, bonds still remain a bit weak. You know, they're still kind of in the overall danger zone down there. I still think bonds are a really good play, but a play that needs a lot of time. You guys know that I have a leap call on the TLT, but I'd be lying to you if I said that I expect it to go anywhere within the next 3-4 weeks, right? Probably going to take a lot of time to get some lift on that trade. And lastly, gold. Gold, another rocket day for gold, guys, up almost another 3%. Gold has been extremely volatile, right? It looks like Palantir, daily downtrend, engulfing move. So now we're looking for a higher low. Where are we looking for? 33.50. Tap back into it. Higher low. This is a breakout retest, possibly around the 12 EMA, this yellow line. That is a beautiful trade setup overall for a possible continuation long. They tried to come back and test the 12 EMA, couldn't get it done. We might be just looking for another weekly leg higher. It might just come up and fracture the $3,500 mark. I mean, as I was saying, when we were pulling back, I would not be surprised if gold has a bit more left in the tank. It goes through its consolidation phases, but as we still see a lot of uncertainty and you do not see people flocking back into the dollar, central banks have been buying a lot of gold, and I would expect that to continue overall. So keep that in mind when you're looking at gold. And now lastly, Bitcoin. Bitcoin, you know, also getting a nice little lift today, 2.22% to the upside, looking pretty good. We know that Bitcoin never lost a daily uptrend. It was looking for a daily higher low. We put in equal lows at around 94K. Now maybe looking to fracture the top. You fracture the top, the next stop up here is all the way to about 102 to 105, all the way up there to the all-time high psychological area of resistance. You can argue that there's maybe another zone right here, which we're kind of struggling with. That is true, but of course, the big ones, guys, on the weekly time frame, right? The big ones are below us, 92 to 87, and another big one up here, 100 to about 105. So weekly uptrend is maintained by the bulls right now. We'll see if they can get that expansion overall with continued weakness on the dollar. All right, now let's move into our big tech names, shall we? And let's go have a look first at Apple. Good old Apple. Even though the whole sector was down today, Apple was not down that much. They're still trying to do one very clear thing. They're looking for a new daily higher low. Anything above 190 looking for a higher low for possible trend continuation. If they do get that, keep in mind resistance stays put at 210 up to 220. A very big line of defense for the bears. That was a big level of support for the bulls for a very long time. Now we've lost it. Now we're kind of oscillating. No new highs on the weekly. So they tried to go for the weekly uptrend, didn't get it. Now maybe we need to find a bit more momentum by reaching into a support range, 196 to 187. If Apple dips down there again, you guys know me, I'll probably be looking to write some short puts in or below the previous fear lows down here, as close as I can down to these guys. 200 weekly EMA, which is down here 180. So if I can get like some mid 180s, I wouldn't mind on Apple. Now the valuation around 200 is a little bit high, which goes to reinforce my point that I really would like to see this one 10% lower to give myself the best possible chance at dealing with this elevated valuation, considering the relatively flat revenues over the last 2 years. Moving on to AMD right now, down 1.96 in the regular trading, and then you can see after earnings, not so much. So, I mean, they're literally where they were over the course of the day. So we'll just leave that analysis put, right? So overall, looking for a daily uptrend continuation. We will see if they get it. If they consolidate tomorrow, looking for a higher low. Anything above 91, looking for a higher low for possible further trend continuation. But where are we trying to do it? Into big resistance for AMD. 113 down to $98 is that very large area of resistance that the bulls have struggled with a few times in the past. We haven't even been able to close above this 12 weekly EMA. So, you know, if you want to see a clear weekly uptrend, well, number one, you got to form it first. And this is somewhat weak for AMD. Give me the 12 EMA back, and then we can see the bulls have somewhat a semblance of short-term control. And the weekly MACD crossing might be an indication of them willing to do that soon, but we'll keep an eye on it, right? If you come back too much or even lose this daily uptrend into a downtrend, you're looking for a weekly higher low, anything above 84, looking for a higher low for possible trend continuation. Now, with their earnings being released and the fact that we just covered them, very solid overall and expanding into the thesis. If you do come lower, I might be picking up a few more shares and or writing some short puts below there. Onto Amazon right now, they were down 0.72% on the day, but not losing the daily uptrend just yet. Your higher lows are here, 179, looking for a higher low for possible further trend continuation, but Amazon has not cracked the range highs. 191 to 180 is that big resistance range for the bulls. It's been problematic for them. And as you can see, no clearly defined weekly uptrend. Double tops, triple tops, whatever you want to call it. So if we do get a loss of the daily by flushing this guy right here, either in one shot or a lower high into lower low, well, then you'll know the daily uptrend is lost and you might just be looking for more weekly consolidation, anything above 165, looking for that consolidation. And I'd be a big fan of writing some short puts down below in those fear lows, as those are the highs of 2021, and Amazon is there with much better fundamentals than they were last time. Just take a look at their earnings that we covered on the channel about last week. It's on the channel in last week's videos. Onto Google right now, down about 0.51%. Also, still just doing a whole lot of nothing in the last 3 days, right? No continuation of the daily uptrend, equal highs, possibly looking for a higher low, anything above 157, looking for a new higher low, maybe for a second or third attempt at clearing this resistance range. 175 roughly all the way down to 162 is that resistance range, a fairly decent area of defense that the bears have been playing recently, right? They're above the short-term moving averages on the daily, but that doesn't mean much when you're dealing with a lot of tariff headlines, right? Now, we do have a nice weekly uptrend in motion, so if ever we give this back, right? Well, then you're just looking for a weekly higher low, anything above 148, looking for a higher low, possibly for another attempt. Get some momentum from down here and try your hand at it again. That's if they don't breach it right away. So there's only 2 trades for me. If we come down here on Google, I'll add more to the long-term portfolio and I'll be looking for some short puts below the market. But if you give me a breakout, retest, well, then maybe I can play the retest area for a bit of a long. Into resistance though now, a little bit tricky, right? Onto Meta. Meta down 2% on the day as they are giving back a little bit of their earnings rally. Very clear daily uptrend on Meta right now, but not able to break that 600 psychological area of resistance. It's been plaguing the bulls now for a couple weeks in a row and still unable to do it. A lot of space though now above the daily higher lows at 531, looking for a daily higher low for possible further trend continuation, but give back too much of it, or just set the daily downtrend right away. You're looking for weekly consolidation. Good thing the bulls have tons of space, right? Nice weekly uptrend. Anything above these lows, 482, looking for a higher low for further trend continuation. If we come back down here into support, which is 533 down to 453, I'll be adding more shares to the long-term portfolio and maybe looking for some swing trade longs out of a more clearly defined level for a bit of a back test by the weekly bulls. Onto Microsoft right now. Microsoft also starting to curl over, getting a little bit tired for the bulls right there. As you can see, guys, I mean, the weekly came up into this zone, but I mean, hey, right? Where do I have it? 433. It's supposed to be about 435. So is it a clear break of previous big resistance highs? No, it's not a clear break, which is why I have not changed the box into a green box just yet. That being said, the expansion has been very clear on the daily, right? Daily is a very nice daily uptrend. Anything right now above 385, looking for a daily higher low for possible second attempt at breaking this. That's if they don't just do it right away. That's still on the table as well. But there's two very clear trades for me on Microsoft right now. One is a clearer breakout, retest, and run. The retest would be a nice long opportunity. Or if we consolidate in this beautiful weekly uptrend, consolidate, and I can find some short puts down here or some swing trade longs in around the lows, that is another trade that I will be exploring, right? Rather than just guessing here, are they just going to keep going? Let the market tell you. Breakout retest provides an entry. Backtest also provides a second entry. Here, in my opinion, there's no trade. Moving on to Netflix right now. Netflix, I mean, even though Netflix has some red days, they don't get any red candles, right? So this chart looks amazing right now. Daily uptrend is just clear as day, so clear as day right now. At this point in time, guys, I mean, anything above like what? You know, the higher lows are actually down here, 908. Anything above 908, because these are equal levels, no new lows. Anything above 908, 905, looking for a daily higher low for possible further trend continuation. Now, these are somewhat inside candles as well. One could make an argument that is a daily higher low, but I mean, when you look at the slower time frames, yeah, in terms of the hourly, they never really lost the hourly time frame into a downtrend. They lost the higher lows, but the bears never converted. So until that happens, right, we can't really say that the daily highs are pretty much in right now. So this is still one move in my book. Though if we do consolidate a bit further, it's just daily consolidation, right? That being said, if you pull back a lot and set up a downtrend, then you'll also know you're in weekly consolidation right now on Netflix. Anything above 821, looking for a weekly higher low, maybe for further trend continuation. Where would we target the previous all-time highs around 1,050 and 1,000, right? That $50 range right there, which would also be synonymous with the 12 EMAs. That would be a likely pullback area for the bulls if ever they choose to pull back after they must be getting a little bit tired at these all-time highs. Netflix had fantastic earnings, but right now at 1,137, they're probably trading around a 45 forward price to earnings and closer, if not to a 2 peg, which is somewhat a little bit rich, even for Netflix. Even if I am a big fan of this company and I own it in my long term, I wouldn't necessarily be buying new shares all the way up here. Now, moving on to NVIDIA. So NVIDIA down about 0.25% today, and NVIDIA also still struggling with the range highs, trapped in resistance right now, 115 to 105. So daily uptrend is clear right now, looking for a higher low, anything above 104, looking for that higher low for further trend continuation. So you really need to clear 115, guys, if you want to have the chance of getting a move into 130, 125, yeah? No clear weekly uptrend. Double tops right here. We will see if they can do it, maybe with Trump's big announcement or some trade talks with China. That'll definitely help NVIDIA out. And Jensen Huang today, when he was talking, seemed quite frustrated with the way that things were playing out in terms of those export restrictions, right? And the stock has been very muted for a long time. NVIDIA hasn't done anything, roughly, in terms of a clear trend, right? For how long? Almost a year at this current time. Now, the valuation down here is quite fair, which means that if we do pull back, you would be looking for a weekly higher low and a nice support down here, 95 to 76. If you pull back, I'll be looking for maybe some swing trades in this lower range, but also selling some puts under the market. So NVIDIA still remains somewhat of a challenging trade, and we'll get to hear from their earnings in a few weeks towards the end of the month. On to Tesla right now. Tesla down about 1.75%. Almost flushing the lows. 272 lows, pay special attention. Lose that, that's a daily downtrend, and you would be heading into weekly consolidation. But weekly consolidation from what? Well, we never really set a weekly uptrend. Double tops, triple tops all over the place. You would just be trapped between this range of resistance, 305 down to 260, this guy right here, and the below support range, 220 to 200. So if I'm looking to range trade, right? Well, I'm looking for big downswings, looking to sell some puts down into there, or maybe load up some longs as close as I can, right? Or the other trade that we're looking for is clear daily uptrend break, sit on this level, then we can enter, set a stop loss below there, and then you have an expansion criteria with a good risk to reward metric, right? That is the trade setups that I do see on Tesla right now. But overall, the price action is staying somewhat muted. We're going to have to wait for it to break one or either direction to really free up some trades on the stock right now. For now, we're just going to have to play the waiting game overall. And I will remind you that right now, short-term valuation for short-term investors remains somewhat expensive, very expensive actually. But for people focusing on the next 5 to 10 years, you may think that this valuation is somewhat respectable in relation to all of their possible long-term gains in several different segments. Onto Palantir right now, down 12% after earnings. Now I know. I covered this one on earnings after hours yesterday. At that point, it was down 9. Today, it went down as much as 14. And people must be upset. Palantir had such great earnings. Why are they down? Well, it's the law of large numbers, guys, right? And it's the theory of just high expectations, too high expectations overall. And the fact that, keep in mind, right, the 2 weeks leading into earnings, this stock was up 37%, 40%. You would have to argue that most of all that bullishness might have been priced in, and it's just due for a healthy pullback out of daily overbought conditions, right? That being said, it is still a very healthy daily uptrend with the higher lows being set at around 89.50. So any move lower looking for a higher low for possible further trend continuation. We will see how long the stock chooses to consolidate. To get the daily lows in, you need to get the hourly uptrend back. So we'll see if they can get it done tomorrow. But all bets are pretty much off for Palantir. If they would consolidate, I'm sure nobody would be surprised. Looking for a higher low, which may free up for you option sellers, may just free up some mid-80s strikes with some huge volatility on Palantir. Overall, the bulls still remain in control of most timeframes here. Weekly downtrend into a massive weekly engulfing move. You're looking for a weekly higher low, anything above 66.80 for that weekly higher low. So even if this goes into a downtrend, I mean, you're not going to be too worried, right? Just looking for a higher low. And the next clean area of support is down here, 96 to roughly 92 bucks. On to SOFI before last, or rather third before last, down 1.01% overall. SOFI as well, doing absolutely nothing over the last 5 days of trade. One of two things is going to have to happen. Either you break 1216 and establish a new daily downtrend, at which point you're into further weekly consolidation. Nice weekly uptrend on SOFI. Looking for a higher low, anything above 1040 for that higher low into support, which is 1170, down to about $9. I'm a big fan of buying it there. Either that happens, or you just oscillate here, and then you go for the daily uptrend continuation and start pushing into the 14 to 16 level. Very difficult to gauge which way it's going to go, but the bulls have been playing good defense around some of the longer-term daily EMAs. And I'll remind you, the one thing that gives me a bullish penchant on this one is the larger-term timeframes here. Monthly higher lows are set. You may just be looking for a rally back into 14 to 16, and it will probably follow the market. The market has good days. SOFI can probably follow. The market has bad days, and you may just end up back into the support range with another possible buying opportunity. And the valuation of SOFI, we covered it after earnings last week. The valuation below $13.50 is quite manageable, all things considered. On to Uber. Uber has earnings tomorrow morning. So it doesn't matter what I'm going to say right now. The stock is going to move 7% overall, yeah? So 7% down would be just a retest of this prior area we just broke out from, roughly 80 down to 77.5 is going to be the target range. You'd be looking for a daily uptrend, right? Back test of the higher lows right here, 77.41. Back test, maybe continuation, but take back too much if earnings are bad. Well, then you may open up the door here, guys, for a breakdown, right? So you'd like to see a shallow slowing down of a move into here. Then you might know that the bulls are grabbing control again. But if it's just one big gap down after earnings and you clear it, then you're probably going to get a lower high and maybe lower low and just into a weekly consolidation for phase for Uber. So weekly downtrend. Nice uptrend here, looking for a higher low for possible further trend continuation. We will monitor it, or they have a phenomenal earnings and they just blast off, at which point I probably won't be buying. The time to buy, I said it many times on the channel. How many times, I don't know, I've said that Uber was a buy in these lower locations in the past 5, 6, 7, 8 months. I have some for my long-term portfolios. Hopefully you guys too, because even at 70, it was a great buy. I will do their earnings tomorrow after the close, as they are tomorrow before the open. And now lastly, TSM down 2.34%, also into daily consolidation mode on TSM right now. As you can see right now, daily uptrend is very nice for the stock. Higher lows are set right now at 160, looking for a higher low, dipping back into support. 172 down to 156 is that support range. We'll see if they can find a base and maybe plow into this resistance range again, 183 up to roughly 192. One thing's clear though, if they lose it, and dive deeper into that support range, you're just looking on the weekly timeframes, which are the clearest ones in my opinion, looking for a weekly higher low, guys. Anything at this point above 146, looking for a higher low for possible further trend continuation. So I'll be a big fan if it does come back down there, maybe adding more to my long-term portfolio, but also for some short puts, come down there, I can probably write down here in the mid 140 to 130 range, which is a more, valuable area for me. The valuation down there is very, very, very juicy. So I'd like to play any short puts below that mid 150 mark overall on TSM. Fantastic company, reiterated the demand was very strong for the next 2 years. And that is it for today's video, guys. Hopefully you enjoyed. Sorry, I try to get through indexes and TA a bit fast because I try to give you guys so many earnings because I know regularly we only cover the big tech names. Sometimes I dive into more, such as HIMS today, which had a crazy day. Really happy I bought some down there. We usually look at all these names on the Sunday videos and sometimes on the Friday videos as well. So sorry that I can't bring up too much of them, but I try to cover them when they have earnings, right? Like yesterday I covered HIMS, and that analysis on HIMS should be good for everybody for the next 2-3 weeks. That's why I try to cover a lot of earnings all throughout to give you guys an idea of other companies that I don't often look at and what's my impression for them for swing trades or long terms, right? So keep that in mind. But hopefully you enjoyed today's video. If you did, consider dropping a like, would appreciate it. Also consider subscribing if you're new. We do these every Monday to Friday. And if you have any questions, always feel free to ask down below in the comment section. Love answering your guys' questions. And lastly, if you are looking for a trading Discord group to call home, you might consider joining ours with over 150 members, all relatively trading the same strategies, some with small accounts, medium accounts, big accounts. There's something for everybody. You get access to all of my weekly trades, which encompass many different trading strategies, such as the wheel strategy, put credit spreads, call debit spreads, leap calls, swing trades with shares, and long-term portfolio creations. You get access to all of those trades, even earnings trades when I do them. And you also get access to our private morning live streams that we do Monday through Friday for 2-3 hours after the open, where I take your questions on your stocks, your options, your long-term portfolios, everything in between. If you can't be there, they're always recorded, and you can ask me any of your questions in our chat rooms all throughout the day. I'm very active in there, 9 a.m. to 9 p.m. overall. You get access to our private videos where I go over more advanced strategies and different option strategies for small, medium, large accounts that I don't really cover on YouTube, and access to all of my watch lists and all my technical analysis, support resistance, and all of the fundamental analysis on over 150 plus stocks that I do. If you're interested, the link is down below in the video description. Hopefully I see you in there soon. And if not, I'll see you back here. That's it for me today, guys. Take care. See you tomorrow after the market close. Have a good day and peace.